Meet Mike. Mike makes $3,000 a month. Mike also owes $40,000 on 3 credit cards, a car loan, and something called buy now, pay later that he used to buy a blender. A lender on a payment plan. And here's the part that should scare you. The bank that lent Mike all that money is not worried. In fact, the bank is happy. Banks love people like Mike, not because they're evil, well, a little, but because Mike drowning in debt is exactly the customer the entire financial system was built for. By the end of this video, you'll understand why debt isn't just borrowing money. It's a machine. A machine so big that entire countries run on it, get addicted to it, and can never fully pay it back on purpose. Let's strip this down to the simplest version possible. Debt is just one person or one government saying, give me money now, I'll give you back more money later. That more is called interest, and interest is the entire reason lending exists. Nobody lends money for free. If they did, banks would just be very generous charities, and banks are not that. Think of debt like a treadmill. You step on it, starts moving, and now you have to keep running just to stay in place because the treadmill, your interest, never stops. Fall behind and it doesn't slow down for you, it speeds up. That's debt in one sentence, a treadmill that charges you rent for standing on it. Here's a detail most people never think about. Interest rates are the bank's way of pricing risk. Lend to someone super reliable and the rate is low. Lend to Mike already juggling 3 cards and the rate shoots up because the bank knows there's a real chance he won't pay it all back. So the riskier you look, the more expensive it becomes to borrow, which usually makes risky situations even riskier. Here's a fun fact that annoys people every time. Banks don't make money when you pay off your debt fast. They make money when you don't. Picture 2 versions of Mike. Version 1 pays only the minimum on his credit card every month, forever. Version 2 grits his teeth and pays it off in 6 months. The bank loves version 1 Mike. He might pay back double, even triple what he originally borrowed, just in slow, tiny bites of interest that feel harmless at the time. That's why credit card minimum payments are set so low, low enough that you barely notice, but high enough that the treadmill just keeps going. This isn't a conspiracy, it's just the business model. A bank is not your friend cheering for you to get out of debt. It's more like a gym that profits the most from members who buy a yearly pass and never show up. Now here's where people get confused, because we're taught all debt is bad, and that's just not true. Meet Sarah. Sarah borrows $50,000 to buy a small food truck. That truck makes her $80,000 a year in profit. She pays off the loan in under a year and keeps the truck. That debt bought her a machine that prints money. That's good debt. You borrow to build something that pays you back more than it cost. Now meet Mike again. Mike borrowed $40,000 for credit cards, car payments, and a blender he uses twice a year to make smoothies he never finishes. None of that debt makes Mike money. It just sits there quietly eating his paycheck every month through interest. That's bad debt. You borrow for stuff that loses value the second you own it. Same treadmill, completely different reason for stepping on it. Sarah's treadmill is attached to a money printing food truck. Mike's treadmill is attached to a blender. You can guess who's more tired by the end of the year. Here's a quick test you can actually use in real life. Before borrowing for anything, ask, will this pay me back or just cost me later? A loan for a laptop you need to freelance. That can pay you back. A loan for a vacation you can't really afford. That's just future you paying for past you's fun with extra fees attached. Here's the twist. Nobody tells you. The entire global economy needs debt to keep growing. Not can survive with it, needs it. Imagine an economy with zero debt. No loans, no credit, nothing. Sarah can't borrow to buy her food truck. She has to save up $50,000 first, which takes her 12 years working a regular job. In those 12 years, she never builds the truck, never hires 2 employees, never makes anyone a burrito. The economy just waits. Growth basically freezes because everyone's stuck saving instead of building. Debt is what lets Sarah skip the 12-year wait. She borrows the future money and puts it to work today. Multiplies Sarah by a few 100 million people and businesses all doing the same thing. Building shops, hiring workers, buying equipment before they've technically earned it yet, and you get an entire economy moving faster than it ever could on savings alone. Debt isn't a glitch in the system. Debt is the system's engine. Take it away, it stalls out completely. Every house bought on a mortgage, every small business started on a loan, every new store that hired your cousin, a huge chunk of that only exists because someone somewhere was allowed to borrow first and pay later. Now let's zoom all the way out because this is where it gets genuinely strange. Governments, especially ones like the US, owe trillions of dollars, not thousands, not millions, trillions with a T. And here's the part that breaks people's brains, that government is also the one that prints the money it owes. Imagine if Mike could just walk into a room, print his own cash, and hand it to the credit card company. Mike would never actually be broke. He'd just make more money whenever the bill showed up. Sounds like cheating, right? Governments that control their own currency are, in a weird way, doing a version of this. They're not writing bad checks out of nowhere. There are real limits, and printing too much causes its own huge problem called inflation, which is a topic for another video. But the point is, for these governments, debt doesn't work the same way it works for you and me. You can't print your way out of your car loan. A country sometimes kind of can. That's the illusion. We're taught to picture government debt exactly like our own debt, a scary number that has to be paid back dollar for dollar, or everything collapses. In reality, it behaves more like a treadmill that's allowed to run forever, as long as the economy underneath it keeps growing fast enough to keep pace with it. But, and this is important, can run forever doesn't mean no consequences ever. If a country prints too much or borrows way faster than its economy grows, prices shoot up, trust in the currency drops, and suddenly everyone's dollars, pesos, or pounds buy a lot less. Mike printing his own money to pay off his blender doesn't just make the blender free. Eventually everyone finds out what he's doing, and his printed cash becomes as worthless as monopoly money. So the treadmill can technically run forever. But crank the speed up too fast and it throws everyone off it at once. Ask anyone who's lived through a country where prices doubled every few months. The treadmill didn't stop. It just spun so fast nobody could stay on anymore. So next time someone tells you debt is just bad, avoid it completely. Remember Sarah and her food truck. And next time the news says a country's debt number sounds terrifying, remember that the rules are different when you're the one printing the money. The real question was never, is debt good or bad? It's this: are you, Sarah, borrowing to build something bigger than the debt, or are you, Mike, still paying off a blender he used twice, one slow bite of interest at a time? Either way, the treadmill's already running. The only choice you actually get is what you're running toward. If it landed for you, you're exactly who we make these for. Every week at Dumb Economics, we rip open the hidden math behind the economy so you don't have to. Hit subscribe to catch the next one. See you there.